On the 19th of August, we bought shares in two companies with our own money. So, before anything else, the important part. We own both of these. That means we are not neutral about them, and you should weigh everything that follows knowing that. This is what we did and why. It is not what you should do. The first is Uber. You know what it does, so let us go straight to what our own page said about it. Strong buy. That is the highest verdict our valuation read gives, and it does not hand it out often. And here is the thing that convinced us. Over the last 10 years, people have paid about $43 for every dollar a year of Uber's profit. Today, you pay $17 for a company that is bigger and more profitable than it has ever been. The reason that changed is simple. For years, Uber was a story about growth that burned money. Last year, it produced $9.8 billion of actual cash, and it earns about 26 cents a year on every dollar it puts to work. The story turned into a business. Now, the part we are not going to skip, because it is on the same page. That verdict says strong buy with caution. Its short-term resources are tight relative to the bills it owes this year, and there is live litigation. The business quality is strong, and the balance sheet is only moderate. Both of those things are true at once. The second company is Carvana, and it is a completely different kind of decision. 4 years ago, it nearly went under. Then it did something rare. It fixed the actual business, turning a company that lost 36 cents on every dollar of sales into one that makes 9. And we are not alone on that one. 10 of the well-known investors we track hold it, and last quarter, every single one of them either bought more or opened a brand new position. Not one sold. That is unusual enough to pay attention to. Carvana's risk is almost the mirror image of Uber's. With Uber, the question is the balance sheet. With Carvana, 13% of the shares are sold short, which means a lot of money is positioned for it to fall. Our own read on the price is fairly valued, not a bargain. We are paying a fair price for a recovery we think continues. So that is why both, and why together. One is a proven cash machine at a price it has almost never been. The other is a genuine turnaround at a fair price, with serious people on both sides of it. They can be wrong in different ways, which is rather the point of owning two. And to close where we started, we own both of these, so treat everything we just said as interested rather than neutral. We showed you the same pages you can open yourself, including the parts that argue against us. That is what we did and why. Visit us at smartcharts.co, where we explain the stock market in plain English for people who were never given the manual. Nothing here is financial advice.